Hi everyone, good morning. I am Santosh Mahapatra. So today I will work out a problem and solution related to the scope of total income according to residential status, or we can say that computation of total income according to residential status. So how to calculate the scope of total income according to residential status? If an SSC is an ordinary resident, not ordinarily resident, and non-resident. So the entire problem has been worked out on the board, and I will explain you the financial transaction or the scope of total income according to the question and how it is being treated on the board. So here the first one, let us see the first one. Profit from a profession in Pune, receive in Singapore. That is mentioned, profit from a profession in Pune, receive in Singapore. So Pune is an Indian city. So here the nature of income is Indian income. So rupees 70,000, it is taxable in all three cases. Rupees 70,000, it is taxable in all three cases because it is an Indian income. The second one, income from a house property in Australia in receive in India. Income from a house property in Australia, receive in India. Let us come to the second income, that is income from house property in Australia, receive in India. So here the income has been received in India. So the nature of income is that Indian income. So it is taxable in all three cases. 1,45,000. So as it is an Indian income, it is taxable in all three cases. I mean, it is taxable in case of a ordinary resident, not ordinary resident, and non-resident, because it is an Indian income. And the third one, loss from a house property in Singapore. The rent is deposited in a bank in Singapore. Loss from a house property in Singapore. It's a foreign country, abroad, and rent is deposited in a bank in Singapore. So first sentence is important. Whether it is deposited anywhere, abroad or India, it doesn't make any difference. So the first sentence is important, that is loss from a house property in Singapore. It will mean that loss from a house property in Singapore, that is foreign income. And it is only taxable in case of a ordinary resident. But as it is a loss, it will be reflected as a minus balance. I mean, that is 60,000. It will be deducted out of the total income. Of the ordinary resident. So that's why it is mentioned minus 60,000. And it is not taxable in case of a not ordinary resident and non-resident, because it is a foreign income. And the next one, the fourth transaction or the fourth income is that income from a business in Singapore, control from India. Income from a business in Singapore, control from India. It will mean that yes, a business is going on in Singapore, abroad, but it is being controlled or managed from India. It will mean that it is a type of foreign income. Let us come to the board, that is income from a business in Singapore. but income from a business in Singapore, but it is controlled from India. It is controlled from India. It will mean that it is a type of foreign income. It is a type of foreign income and it is taxable in case of a ordinary resident and not ordinary resident. So 85,000 is taxable in case of a ordinary resident and not ordinarily resident. So as it is clearly mentioned, that is income from a business in Singapore controlled from India. The business is going on in Singapore, but it is being controlled or managed from India. So it is a type of foreign income. So it is taxable in both cases. I mean, that is ordinary resident and not ordinary resident. So 85,000 is included in both cases, and it is not included in non-resident. And the next one, income from agriculture. Income from agriculture in Nepal receive in India. Income from agriculture in Nepal receive in India. Yes. So we know that income from agriculture in Nepal receive in India. Yes, that is 30,000. We know that in India agricultural income is exempted under section 10, but income from agriculture in Nepal, it will be treated as a Indian income and it is taxable in all three cases. So income from agriculture in Nepal receive in India, that is a Indian income, rupees 30,000 is taxable in all three cases. Rupees 30,000 in taxable in all three cases, that is ordinary resident, not ordinary resident and non-resident. And the next income, next transaction, that is dividend from a foreign company. I mean dividend received from a foreign company. Dividend received from a foreign company, as it is clearly mentioned. Dividend received from a foreign company. So it is a foreign income. That is dividend received from a foreign company. It's a foreign income. Rupees 62,000 is taxable in case of a ordinary resident only. It is not taxable in case of a not ordinary resident and not taxable in case of a non-resident. As it is a foreign income, it is only taxable in case of a one category, that is ordinary resident. And another thing, technical fees received from a foreign company. Next one, technical fees received outside India from a foreign company for technical services provided for a project in Hong Kong. It will mean that it's a foreign income. Again, I am repeating, technical fees received outside India from a foreign company for a technical services provided for a project in Hong Kong, both in foreign country. The services in Hong Kong and the company is a foreign company, and the company is a foreign company. So that is foreign income. So 1,25,000 is purely a foreign income, and it is taxable in case of a ordinary resident. And the last one, that is past untaxed profit brought to India. So it is not taxable, as it is related to past untaxed profit, as it is not related to relevant previous year. So it is not taxable in all three cases. Past untaxed profit brought to India, that is past income, not taxable. So these are the scope of total income. When in a question certain transaction, financial transaction are given, then the question, we have to work out the scope of total income on the basis of residential status. So when we are making total of all three, that is the scope of total income. If a person is an ordinary resident, not ordinary resident, and non-resident.